Welcome to A Better You podcast. Let's start today to develop a better you. This podcast takes on life's challenges and obstacles, such as overcoming addictions, behaviors, midlife career changes, to keeping your family together. The show that gives you...
It is great to be with you again this week. In episode 3, I am going to continue to talk about life insurance. Specifically, we're going to talk about 4 different types of life insurance: term insurance, whole life insurance, universal life, and index universal life. So let's get into this first one. How does term life work? Term life insurance is typically sold in lengths of 1, 5, 10, 15, 20, 25, or even 30 years. Coverage amounts vary depending on the policy, but can go into the millions. Now, level premium term life insurance locks in the same price for the length of the policy. Annual renewable term life is a 1-year policy that renews every year. Annual policies can be used if you have short-term debts or need coverage for a brief period of time. And if you need more information on that, I can give it to you. Here's the pro and here's the con. It's often the cheapest life insurance, and it's sufficient for most people. The con is this: if you outlive your policy, your beneficiaries won't receive a payout. In other words, you do a 10, 15, 20 year, and you did it at 25 years old. Now you're turning 45 years old. And that 20 years that you paid into that policy, there's no cash value. So all that money is out the window, so to speak, and you have to start over from scratch. The difference is you're 20 years later, and the question is, how's your health? Now, the next insurance policy that I want to touch on in this episode is whole life insurance, permanent life insurance. Whole life insurance typically lasts until your death, as long as you pay the premiums. It's the closest thing to what's called set it and forget it life insurance. In other words, you put it into play, it's locked in, and you don't really have a lot to be concerned about. In general, your premiums stay the same. You get a guaranteed rate of return on the policy's cash value, which I've seen from 2 to 4%, even upwards 6%. And the death benefit amount doesn't change, which is good news. Again, pros and cons. The pros, it covers you for your entire life and builds a cash value. So your money isn't necessarily being thrown out the window, right? There's cash value there. So if you need to 10 years, 15, 20 years from now, go and take a loan out, you don't have to go to the bank. You can get the money from your own policy, which is a great thing. Here's the con. It's typically more expensive than term insurance. So if you're looking for affordable life insurance, you might want to explore other options. But if your health, if you have good health, this is a good product. This is a good policy for you to go with. Now, let's talk about universal life insurance, what could be called guaranteed universal life insurance. Here's how it works. The death benefit is guaranteed, and your premiums won't change. There's typically little to no cash value within the policy, and insurers demand on-time payments. So you can't play around with this. You can choose the age to which you want the death benefit guaranteed, such as 95, 100 years old. You know, people are living longer now. Baby boomers are living longer now. Again, pros and cons. The pros, Due to the minimal cash value, it's cheaper than whole life and other forms of universal life insurance. Cons, you miss a payment, and missing that payment could mean you forfeit the policy. And since there's no cash value in the policy, you'd walk away with nothing. Now, let's talk about index universal life insurance, which has great features. Here's how it works. The index universal life insurance product is a securities product. It's linked to the policy's cash value component, to a stock market index like the S&P 500. Your gains are determined by a formula, which is outlined in the policy. For example, it mirrors or shadows the S&P 500. So when the S&P 500 is up, it's up. When it's down, it's down. Good news is, and I'll touch on this in the cons, if it drops, there's a safety there for you, which is so important. Now, your gains, again, I want to make this clear, are determined by a formula, which is outlined in the actual policy. The pros, you can access cash value, which grows over time. This is where you hear and you see a lot of YouTube videos on create your own bank. Again, the pros, you may see considerable gains if the stock market performs well. Within limits, your payments and death benefit amount are flexible. Here's what you have to get in terms of the pros. And here's where the safety comes into play. If the S&P 500 stock market is at a negative 12%, guess what happens to this index securities product? It freezes. It doesn't drop like the S&P 500 drops. So in other words, there's safety and there's protection. You don't lose money. Now, the good news is that there's still some small benefit in that you can have a guarantee that you'll still be paid 0.075 on that particular investment. Not a lot of money, but you're not losing money. When you have a 401k or a 403b, as you just saw the market change, front door, you guys, the market change, your 403b or your 401k takes a hit as well. So there's safety in this type of product. Got it? Now, the cons. Due to investment caps, the cash value doesn't take full advantage of the stock market's gains. So again, if the stock market is yielding a 20% return, your max cap on this could be 15%. So your maximum will be 15%. Plus, these policies are often more work than a term or a whole life product, as the investments require monitoring. You have to monitor this type of securities product. Now, some of the features that you need to be aware of, you'll hear terminology or see terminology like the participation rate. The policy will dictate how much your cash value participates in any gains. For example, if your participation rate is 80% and the S&P 500 goes up 10%, I was touching on this a moment ago, you get an 8% return. If the index goes down, you won't lose cash. Again, you'll just get a zero rate of return. Again, if you have a guaranteed, it may be 0.075%, right? Some policies offer a small guarantee interest rate in case the market goes down, and that's the type of product that you want to have. The cap on gains. Your cash value gains are subject to a cap. So if the index again goes up 20% and your cap is 10%, you'll get only a 10% return. Ideal product, you want to have at least a 15% max, which is really good. Now, there's a death benefit and flexible premiums that you have to understand. Some policies let you adjust your death benefit as your family's needs change. Within limits, you can also decrease your premiums or skip a payment as long as your cash value covers the cost. If you're skipping payments and you don't have enough cash value to cover the costs, your policy could lapse. It could be in danger. So again, this is a type of product you have to pay attention to and you have to understand. And so if you go with a product like this, which is a premier product, it has a host of benefits and great features. And oftentimes you are able to tie a LTC to it, a long-term care product to this, which carries great benefits with a product like this. It's what you want when you're planning your retirement, when you're looking ahead and making sure that you don't fail yourself in your latter years if you get blindsided by, life throws you lemons sometimes, and out of nowhere we get these crazy diagnoses and you go like, how did that happen? I don't know how that happened. So you want to prepare for that, right? So with that being said, that concludes this episode today. I hope you have gotten some good nuggets out of it. And with that being said, again, if you have any questions, pop it in the box below and we'll make sure we answer your questions. If you'd like to schedule a 30-minute financial literacy session with us, I'll make sure I get you set up for that. That's it. That's all. Thank you for joining me on A Better You today. Until the next time, God bless.